The private space bubble is about to pop, and why you're already invested. How much of your retirement is riding on companies that haven't earned a dollar of profit? The space boom looks like 1999 with rockets, huge optimism, tiny cash flows. Many innovation, ETFs now have double-digit exposure to negative cash burn and serial diluters. Here's the twist. Broad funds you think are safe quietly hold De-SPAC space names and satellite bets that depend on rosy timelines. I'm going to show you where the bubble is, how it spreads into your portfolio, and a 5-minute way to check your exposure. Rates are up, liquidity's thinner, timelines keep slipping, and the math is turning fast. Okay, so basically the core problem is simple. Valuations are anchored to future fantasies, not present cash flows. When interest rates were near zero, paying up for profits 5 to 10 years out felt painless. Today, higher rates punish long duration, pre-revenue bets because every dollar of profit that arrives late gets discounted harder. The result? Price-to-dream multiples that made sense in 2021 look fragile in 2025. Here's what most people miss. The urgency isn't abstract. Liquidity is fading. Venture rounds take longer, credit is tighter, and secondary offerings come at steeper discounts. Many De-SPAC space companies are burning cash faster than they can raise it. Lockups expired, insider shares unlocked, and the market now demands progress, not promises. Meanwhile, milestones slide, launches shift by quarters, regulatory approvals drag, supply chains hiccup, and the spreadsheet that once showed a hockey stick now shows push-outs and dilution. That's exactly what you saw sector-wide after 2021's SPAC peak. Optimistic timelines met higher rates, pushing inflection next year into inflection in a few years. Think of it like layaway profits at credit card interest rates. If the payoff moves out while the rate you use to value it goes up, the present value shrinks. Multiply that across small launch vehicles, satellite constellations, and in-space services, and the compounding effect is brutal. A single quarter slip isn't just a PR problem. It's valuation compression in real time. Everything clicked when I realized this isn't just a space story. It's a portfolio story. The innovation, next-gen tech, and even some broad market ETFs you hold through retirement accounts quietly repackaged private market risk into public tickers. You didn't opt into these one by one. They arrived as index creep, theme funds expanding mandates to fill quotas and keep assets sticky. The exposure hides in the details. Negative operating cash flow, serial equity raises, De-SPAC pedigrees, and guidance that wobbles each quarter. So why now? Rates are a headwind, liquidity is constrained, and the narrative tailwind is losing thrust. SPAC lockups are over, warrant overhangs linger, and each miss forces more equity issuance at lower prices. That's the cycle. Therefore, here's the map. First, we'll unpack fantasy cash flows and the dot-com echoes. Then we'll show how the space sector prices dreams as if they're deposits. Finally, we'll trace how that risk leaks into your funds and how to run a fast exposure check. The key idea: understanding timing and discounting beats, chasing total addressable market slides. Let's build the foundation, the fantasy. The bubble's foundation, fantasy cash flow, dot-com parallels. The simple version is this: when most of the expected profits sit far in the future, the stock becomes a bet on time. As discount rates rise, those far-off dollars get smaller today. That's duration risk, and it's vicious in pre-profit industries. The dot-com era had the same structure. Dominate later, bleed now. Pets.com didn't fail because the internet was fake. It failed because validation wasn't valuation. The logic, win market share, figure out margins later, can work if capital is free and time is forgiven. Neither is true right now. Here's the weird part. In space, the scope is genuinely exciting. Small launch vehicles promising dedicated rides, satellite constellations selling data or bandwidth, and in-space services from refueling to debris removal. But the financing logic often rhymes with 1999. Decks tout trillion-dollar TAMs, heroic launch cadences next year, and smooth curves to EBITDA positive, while milestones slip and cash burn rises. Government anchor contracts get waved around as proof of inevitability, even though milestone payments don't equal recurring margins, and hardware economics remain thin until scale and reliability arrive. Think of it like pre-selling a stadium's season tickets for a team that doesn't yet exist, in a league that's still setting the rules, using a stadium that's under construction. You can model full seats. You just can't bank the concessions until the doors open on time, every time. In other words, timing of revenue matters more than the size of the market. That's why weekly next year promises so often fade into monthly for now. What this actually means is the industry's core bottlenecks: test cadence, engine reliability, range availability, supply chain for exotic materials, regulatory approvals, act like friction that pushes the inflection point out by quarters. Each push-out doesn't just delay the party, it changes the math. Under a higher discount rate, moving cash flows from year 3 to year 5 can kneecap fair value. Here's what most investors miss. Deck-level TAMs don't pay bills. Operating cash flow does. If an orbital service requires flawless launch cadence and multi-mission reliability to clear fixed costs, one failed launch can erase a year of margin. That fragility turns near-term profitability into next-year profitability repeatedly. As misses compound, the market stops capitalizing the dream and starts demanding proof of unit economics. Price per kilogram, turnaround times, refurbishment rates, failure probabilities, insurance costs, and actual customer stickiness beyond government pilots. Everything clicked when I compared the dot-com playbook to today's space decks. Validation versus valuation. A pilot contract, like early web traffic, proves interest, not profit. TAM inflation. If we get 1% of a trillion was weak in 1999, it's weak now. Slide deck smoothness. Straight lines in PowerPoint meet lumpy reality in hardware. Subsidy dependence. Low-rate money and sponsor incentives can mask weak unit economics, until they don't. The counterintuitive part is that optimism isn't the enemy. Mistimed optimism is. The internet ultimately delivered the commerce and cloud markets people imagined, but timelines and survivors differed wildly from the decks. The winners were the ones that reached cash flow generation, managed burn, and built moats while others diluted to survive. In space, the same dynamic is forming. A few platforms with real scale, repeatability, and diversified revenue may thrive. Many others, especially those dependent on constant capital raises, face the grinder of higher rates and slower milestones. Here's a quick microstory shape we'll explore soon. An investor deck calls a revenue inflection next quarter. Then next quarter comes 6 times. Engines need additional tests. Regulators ask for more data. A launch window slips. The company burns another $50 to $100 million and extends runway with a discounted raise. The DCF that once assumed cash flows in year 3 now starts in year 5. At a higher discount rate, that re-anchors the valuation lower, even if the ultimate dream is unchanged. That's the gut punch investors feel. Same story, harsher math. In other words, the bubble's foundation is a pricing mechanism that treats future, uncertain cash flows as if they're near and inevitable. It's not fraud, it's framing. When capital was cheap, that framing felt reasonable. With capital dear, it looks exposed. Government contracts help, but milestones don't equal margins, and milestone revenue can vanish with a failed test. For investors, the takeaway is blunt. Before you buy the TAM, test the timing. Ask what has to go right on what schedule with what failure rate, and how is it financed? If the answers depend on free capital and flawless execution, you're back in 1999, only this time the pets are satellites and missed deliveries fall from orbit. How fantasy pricing is built in space. Okay, so basically, fantasy pricing in space starts with imaginary cash flows dressed up as precision. Teams plug forecasted revenue into real discounted cash flow models, but the inputs come from slide decks, not operating history. Think of it like building a mortgage on a house that hasn't been constructed, using an appraisal from the architect's imagination. The math is correct, the assumptions aren't stable. Here's the playbook. Step 1, a massive TAM slide. Data, launch, logistics, trillions down the road. Step 2, a hockey stick curve around year 5. The line glides from negative gross margins to break even, then leaps to positive EBITDA on a tight schedule. Step 3, thin unit economics expressed as a percentage that looks fine in the abstract. We'll hit 40% gross margins once we reach weekly cadence. Step 4, cost curves that assume manufacturing learning rates and refurbishment cycles that haven't been proven at scale. The result is a spreadsheet that turns physics and manufacturing risk into calendar entries. Now the launch cadence myth. Decks love weekly launches next year, but hardware is lumpy. Test campaigns take longer. Engines need more firings. Range availability is constrained. Supply chains for carbon composites, turbopumps, avionics, and exotic alloys still wobble. Regulators move cautiously after anomalies. Each of those frictions stretches the calendar. A delay of 1/4 compounds across integration, insurance, and customer manifests. That's why weekly next year tends to become monthly for now, and then we're optimizing reliability before ramping. Cadence. In other words, cadence assumptions break first, and when cadence breaks, unit economics follow. Here's what most people miss about government anchors. A signed contract looks like certainty, but space contracts are often milestone-based, cancellation-prone, and narrow in scope. A hot fire test payment hits the P&L, but it's not recurring margin. A demonstration mission isn't a multi-year subscription. Government customers can delay, rescope, or rebid. And when milestones slip, cash receipts slip too. The DCF still books recurring revenue in year 4 because the deck says production phase, but the actual receipts depend on flawless execution and procurement timing you don't control. Think of it like pre-selling stadium tickets before there's a team, then treating each construction inspection as revenue while the doors are still closed. Milestone money keeps the lights on, but concession profits only arrive when games happen on schedule and fans return week after week. Until then, you're modeling snacks that haven't been cooked. The counterintuitive part is how thin the error budget is. Launch vehicle gross margins depend on a certain cadence, a certain reuse rate, and a failure rate that trends toward zero. Satellite data services depend on constellation density, latency, and uptime. In-space services depend on rendezvous reliability and insurance that doesn't blow the economics. One-off nominal event can wipe a year of expected margin. Yet the model assumes linear improvement and uninterrupted learning curves. That's not fraud. That's optimism smuggled into cells C37 through G92. Now layer on SPAC-era permissiveness. Under traditional IPO rules, companies can't publish aggressive forward projections. SPAC mergers allowed glossy multi-year forecasts. Bankers modeled those projections, sponsors amplified them, and public investors underwrote them. The real DCF gave the whole thing a varnish of rigor. But the cash flows were still imaginary. When rates were near zero, the present value of year 5 cash looked huge. With higher rates and slips, that value shrinks fast. Everything clicked when I looked at launch cadence versus unit cost curves. If you model 40 launches a year at 80% first stage reuse, your per launch cost drops nicely. If you hit 14 launches and reuse lags, your per launch cost stays high. That means your price per kilogram must rise, but customers can go to cheaper ride shares. So you discount to keep the manifest, which crushes gross margin and pushes EBITDA out. The DCF doesn't break because the formula changed. It breaks because the line item's date shifted and the competition changed your achievable price. Here's the weird part. Even real progress doesn't save fantasy pricing if the timing moves. Hitting orbit once is validation. Hitting it reliably at low cost is valuation. Until reliability and cadence show up together, your spreadsheet is a confidence thermometer. And confidence swings with burns, misses, and financing terms. In other words, fantasy pricing in space is built by importing best-case engineering timelines into financial models and treating government milestones as recurring revenue. The simple version is, the structure is quantitative, but the scaffolding is narrative. If your model depends on flawless cadence, high reuse, soft insurance markets, stable suppliers, permissive regulators, and cheap capital, all at once, you're not valuing a business, you're betting on perfection. The safer move is to haircut cadence, add delays, thicken failure tails, and price capital at today's rate. Do that, and the fair value drops to a level that looks insulting to the dream, but honest to the cash. The slipping inflection. I sat with a CFO who'd pitched the same slide for 6 quarters. Revenue inflection next quarter. The first time, the room buzzed. The 6th time, it was quiet enough to hear the air conditioner. Here's what happened. Quarter 1, the company burns $70 million. The deck shows 3 launches in the next 6 months, a government milestone payment, and a big constellation contract moving from pilot to production. Cash runway, 18 months. The DCF starts meaningful cash flows in year 3 at a 10% discount rate. Fair value looks heroic. Then an engine test reveals a vibration mode they don't like. Smart call, pause, redesign a turbopump component, add test cycles. Launch 1 slips a quarter. The milestone payment shifts. Burn doesn't. Cash runway shortens to 15 months. Quarter 2, they rebaseline. We're building a more reliable system. Everyone nods. But range availability tightens because another provider booked the slot. Now launch 2 pushes as well. The Constellation customer asks for a revised schedule and threatens to move a payload to a rideshare if the new date isn't firm. The CFO keeps the Inflection next quarter slide, arguing the backlog will convert. Burn, another $65 million. Runway, 12 months. Quarter 3, an insurance underwriter. Requests additional data after an anomaly at a competitor spooks the market. Premiums rise. The company decides to self-insure one mission to keep the schedule. That sounds bold, but it moves risk onto the P&L. Another $60 million burns through R&D, range fees, and supplier pre-buys. Cash runway, under a year. The board asks about financing. The market wants a discount and warrants. The CFO says, after the inflection, terms improve. Quarter 4, a regulator asks for more documentation on flight termination systems. Review stretches. A launch window opens, then closes due to weather. The team hustles. Morale holds, but time doesn't. Burn, $55 million. Cash runway, 7 months. The bank syndicate suggests a convertible at a lower price. The sponsor suggests a PIPE if they can show one successful mission and a signed production option. The DCF moves its cash flow start to year 4 and bumps the discount rate to reflect market conditions. Fair value compresses sharply. Quarter 5, they hit orbit. The room erupts. Validation, finally. But the payload is a demo, not revenue generating. The milestone payment lands, but the Constellation customer still wants guaranteed cadence. Insurance costs remain high. The second launch scrubs twice. Burn slows a bit as CAPEX peaks, but cash runway is now 5 months. They raise equity at a larger discount with warrants attached, adding dilution and a warrant overhang that will cap future rallies. The DCF now starts meaningful cash in year 5. At the new discount rate, valuation falls again despite the technical win. Quarter 6, a competitor offers cheap rideshare slots, undercutting their per kilogram pricing. To keep the manifest, they discount. Gross margin targets slip. The CFO removes the next quarter language and shifts to sequential improvement this year. The room hears what's not said. Burn continues. Another raise looms, but at lower prices because the float is thin and redemptions left few long-term holders. Insider lockups expire. A small wave of selling hits the tape, pushing volatility higher. A covenant tied to backlog conversion triggers a waiver request. The bank agrees, but at the cost of tighter terms. Here's the insight. Each slipped quarter didn't just delay revenue, it multiplied the discount. The model's start date moved right, the discount rate moved up, dilution increased share count, warrant overhang dampened upside, and competitor pricing squeezed unit economics. The dream didn't die. The valuation support did. And once the story turns to show me cash flow, narrative oxygen runs out fast. The CFO later told me, we were right about the physics. We were wrong about the calendar and the capital. That line stuck with me. In space, physics can be solved. Calendars and capital strike back. And for public investors, the difference between next quarter and this quarter is the difference between a stock you can underwrite and a stock you can only hope for. The risk pipeline, SPAC's supercharged speculation. Here's what most people miss. The bubble didn't just appear, it was piped into public markets. The pipe was SPACs. Traditional IPOs restrict forward projections and force a bruising roadshow under skeptical eyes. SPACs flipped that. A blank check company raised cash, merged with a target, and published glossy, multi-year forecasts right in the merger deck. Hope moved from private rooms to public tickers in one step. At the 2020 to 2021 peak, SPAC issuance hit records before the De-SPAC cohort, on average, shed well over half its value. The incentives were stacked. Sponsors got a promote, a big equity slice for closing any deal. Bankers earned fees on the merger, not on decade-long performance. Targets saw a path to capital at a negotiated price rather than a price discovered by a roadshow full of hard questions. Everyone was paid to close. Nobody was paid to be conservative. This might seem backwards, but those mechanics matter more than mission statements. Under SPAC rules, targets could present 5-year revenue and EBITDA curves that a normal IPO banker wouldn't touch. Those curves then flowed into sell-side models, ETF screens, and retail narratives. Suddenly, companies that were years from reliable revenue had a public currency, stock, and a megaphone. The risk wasn't removed, it was redistributed. Everything clicked when I realized where retail fits. Private risk got repackaged into liquid tickers with stories that felt inevitable. Cheaper launch, ubiquitous satellites, in-space servicing. Retail could finally invest in space. But the on-ramp was built on projections that assumed flawless execution and cheap capital. When rates rose and schedules slipped, those projections turned into dilution schedules. Here's the counterintuitive part. SPACs didn't only accelerate timelines, they amplified volatility. High redemptions often left a thin public float. Thin float plus big promises equals violent stock swings around each. Press release. Warrant overhangs created constant selling pressure, capping rallies. Insider lockups staged new supply at predictable intervals. That structure made the chart look like a heart monitor, and that volatility wasn't a bug. It was the byproduct of the instrument. .com déjà vu. In 1999, too much VC money chased .com logos because mandates demanded deployment. With SPACs, mandates to launch vehicles, literal and financial, met sponsors mandated to find a deal before deadlines. Capital chased logos again, this time shaped like rockets. The underwriting bar lowered, the calendar compressed, and public by press release became a business model. Government contracts didn't fix the pipeline's risk. Milestone checks made slides look credible, but didn't change burn, reuse, or cadence realities. And once public, every quarter became a funding referendum. Miss a milestone? The equity lifeline gets pricier. Raise at a discount? Warrant coverage swells, future upside shrinks. ETFs and thematic funds compounded it, buying post-merger names because they fit a theme, not because the cash flows were real. What this actually means is financial engineering turned hope into holdings. You didn't need to pick a single space stock. If you owned innovation or next-gen funds, the pipeline quietly routed De-SPAC names into your account. The narrative said diversification. The mechanics delivered concentration in long-duration, negative cash flow assets. There's one detail to remember. It's going to matter. That thin float and warrant overhang you barely noticed will determine how the unwind trades. We'll come back to that when we map the SPAC-to-ticker mechanics next. SPAC-to-ticker mechanics. Here's the life cycle in plain English. Raise, hunt, merge, project, De-SPAC drawdown. A sponsor raises a blank check pool at $10 per unit. They hunt for a target before the clock runs out. A merger gets agreed. The glossy deck drops with 5-year revenue and EBITDA hockey sticks. Shareholders vote. The deal closes, units split into shares and warrants, and the operating company is now public. Then reality meets projections, and the stock trades on execution instead of aspiration. This is why more than half of De-SPACs have traded far below the $10 trust price after merger. Mechanics met reality. Okay, so basically, projections are the fulcrum. In a traditional IPO, you can't publish aggressive multi-year forecasts. With SPACs, you can. That's why you saw decks with 10x revenue growth by year 3, break-even by year 4, and fat margins by year 5. Bankers ingested those decks into valuation models. ETFs ingested the tickers into themes. The simple version is, permissive projections inflated the starting line, so the first miss looked like betrayal even when the tech was progressing. Now the weird part, redemptions. SPAC IPO investors get the right to redeem their $10 plus interest if they don't like the deal. In practice, redemption rates ran high. That means when the merger closes, very little cash stays in the trust. The company plugs the hole with a pipe or cuts ambition. But high redemptions also leave a thin float, fewer shares actually trading. Thin floats plus loud stories create violent volatility. One press release can send the stock up 40% in the morning and down 30% by the close. That's not just sentiment, it's mechanics. Layer in the warrant overhang. Those SPAC units include warrants, typically exercisable at $11.50. After De-SPAC, you've got a cloud of future sellers waiting to exercise and flip. If the stock rallies, warrant holders sell into strength, capping upside. If it sinks, the warrants sit out of the money, but still hang over the tape like a storm cloud. Either way, every attempt at a sustainable rally hits supply. It's headwind you can't see on a balance sheet, but you feel it in the chart. Then come the lockups. Insiders, sponsors, and early investors agree not to sell for a set period post-merger. When those lockups expire, supply hits the market right when many companies still haven't hit the promised cadence or margins. Prices are lower, liquidity is worse, and now fresh shares want out. That's why you often see a second leg drawdown months after the initial slide. Lockup-driven supply meets projection fatigue. Here's what most people miss about De-SPAC balance sheets. The headline, "We raised $250 million," can mask a trust that was 80% redeemed, a pipe that's conditional, and closing costs that eat meaningful cash. The result is less runway than the deck implied. With burn rates high and milestones slipping, companies tap the market again, secondary offerings, converts, or at-the-market programs. Those raises price at discounts with sweeteners, adding dilution, and sometimes more warrants. The equity becomes a financing tool, not a compounding engine. Public by press release is the end state. The company learns that every quarter is a funding referendum. Announce a contract, pop announce a delay, drop. But remember our thin float and warrant math. Pops fade under selling pressure. Drops accelerate because there aren't committed long-only holders to absorb shock. Meanwhile, ETFs that include space, innovation, or defense tech tickers buy mechanically when shares enter an index or theme, then sell mechanically on outflows. That flow-through creates a feedback loop that has little to do with unit economics and a lot to do with plumbing. In other words, the SPAC-to-ticker path builds a structure where forward projections inflate starting valuations, redemptions thin the float, warrants cap the upside, lockups time release supply, and follow-on financings dilute the base. If execution is flawless, you can climb out. If it's merely good, gravity wins until cash flow flips. And in a higher rate world, the clock runs faster. The practical takeaway: when you see a De-SPAC space name in your fund, assume more volatility, less runway than the deck, and a capital schedule that matters as much as the launch schedule. De-SPAC, Whipsaw, and Contagion. A friend of mine bought a De-SPAC space stock on merger week. Day 1, it jumped 22% on a press release about accelerating launch cadence. He texted me a rocket emoji. Day 5, it was flat. Day 15, it was down 18% on minor schedule adjustments. 60 trading days later, it had bled nearly 80% from the peak. That wasn't random. It was the structure we just walked through, playing out in fast forward. Here's how the whipsaw unfolded. The float was thin because redemptions were high. So early headlines moved price a lot. But the company still had a warrant overhang, so every pop met selling pressure from arbitrage desks clipping the spread. Then the first post-merger quarter hit. The team reiterated the deck. Production ramped this year, break even next year. Markets shrugged. 2 weeks later, they disclosed a slipped milestone, and a lender pointed to a covenant tied to backlog conversion. Suddenly, the stock wasn't trading on space future. It was trading on refinance risk. Liquidity tightened. The price drop forced a dilutive raise, a secondary at a discount with warrants attached. That new supply pushed the chart lower, which made the next raise even pricier. Meanwhile, the ETF that had bought the name on index inclusion faced outflows during a growth scare, so it sold mechanically. That fed the slide, which triggered stop losses and risk controls at funds that never underwrote the projections in the first place. That's the loop. Drops lead to raises. Raises lead to more drops. The kicker was a covenant trip. Not a full breach, just enough to require a waiver and a fee. The filing hit after hours. The next morning, the tape opened down 25% on thin volume. Retail holders tried to buy the dip, but each bounce ran into warrant exercises and an insider lockup that had just expired. Supply overwhelmed curiosity. Within a month, the stock drifted to levels that implied bankruptcy risk despite the company still launching tech demos. The narrative said early innovation leader. The price said distressed equity financing vehicle. Here's the aha most people miss. The volatility wasn't a bug, it was baked in. Thin floats magnify every headline. Warrant overhangs cap rallies. Insider unlocks time release supply. ETF flows turn individual names into passengers of macro tides. And because projections set the starting line too high, even normal hardware hiccups looked like catastrophes. Now the contagion part. That one name sat inside a space ETF, 2 innovation funds, and a defense-themed ETF that had few true defense contractors. When the stock fell, those funds' daily NAV slipped. Target date funds holding those ETFs saw tiny drawdowns. It didn't feel like much until 3 or 4 similar names moved together. correlations spiked. Suddenly, a retiree's diversified account felt choppier, and they had no idea a thin float, warrant-heavy De-SPAC was part of the reason. That's the Whipsaw, a microstructure story that becomes your portfolio's background noise. Here's what my friend said months later. I thought I was betting on rockets. I was actually betting on plumbing, redemptions, warrants, lockups, and ETF flows. Exactly. The engineering mattered for the long run, but the path to get there was paved with financing friction. That friction multiplied small misses into big moves. And unless you're tracking float, warrant counts, lockup calendars, and fund flows, you're trading a story without knowing the dealer's rules. The last twist. Even when the company finally hit a successful mission, the stock barely budged. Warrant sellers faded the move, ETFs were net sellers on outflows, and the market wanted cash flow, not a one-off win. Validation didn't convert to valuation. That's the tell that the bubble's air is thin. Good news marks time, bad news marks down. The fallout, how it hits you. Okay, so this is where it touches your grocery bill. You might not own a single space stock, but you probably own funds that own them. Innovation, space, next-gen defense, and even some broad tech ETFs seed their portfolios with De-SPAC names and pre-profit satellite companies. Those slices look small in isolation, 0.5% here, 1% there. Layer overlap across multiple funds, and you've got hidden concentration in long-duration, negative cash flow bets that all move together when liquidity dries up. That's why a single sector wobble can ripple through your 401k, even if you never clicked buy on a rocket stock. Here's what most people miss. Top 10 lists don't tell the whole story. Many funds sprinkle smaller positions across dozens of speculative names. It feels diversified, but the risk factor is the same. Far-out cash flows with execution and financing risk. When rates rise or milestones slip, correlations climb. Quality sells off alongside junk because ETFs and quant screens sell baskets, not stories. That's why you'll see a day where profitable aerospace names drop within profitable launch startups. Forced flow, not fundamentals. Index creep is a quiet culprit. A space ETF can't fill itself with pure-play space winners because there aren't enough profitable ones. So it expands the mandate to beneficiaries of space, chip makers, industrials, defense primes. That sounds safer, but it also lets the fund tuck in thinly traded De-SPACs under the same umbrella. You think you're owning satellites via a giant semiconductor, but you're also owning two small launch names at 1.5% each. Then you buy a second innovation ETF for diversification, and boom, you double own the same two names without noticing. Retirement accounts add another layer. Target date funds often hold broad growth ETFs that in turn own thematic funds. It's like Russian dolls. The label says age-appropriate risk. The inside includes a handful of De-SPACs riding quarterly financing windows. When those names lurch, your 401k chart has extra wiggle you can't explain. Here's a practical example. An investor holds three funds: a space ETF, an innovation ETF, and a defense tech ETF. None shows a space De-SPAC in their top 10, but the full holdings reveal the same four names across all three. Each is 0.8% to 1.6%. Combined, that's 3% to 5% of the portfolio in the same speculative bucket. Add two satellite operators burning cash and a component supplier reliant on a delayed platform, and you're at 6% to 8% in correlated downside. Not catastrophic, but enough to amplify volatility during drawdowns. Another signal, serial equity raises. If a company repeatedly issues stock to fund operations, every raise resets price lower and drags the ETFs holding it. You won't see that risk on a glossy fact sheet. You see it in 8KS announcing at-the-market programs, in warrant registration statements, and in guidance slips that precede capital raises. Funds often keep holding because the name fits the theme. Your account eats the dilution quietly. Government contracts don't immunize your exposure. Milestone cash helps survival, but doesn't guarantee margins. When budgets shift or tests slip, receipts slide, and the company taps equity markets again. Those cycles cluster across the sector, so several names can raise within a quarter, pulling down the whole space, sleeve in your funds at once. The aha to remember: you own what they own, and what they own tends to move together when money gets tight. To spot it, you have to look past marketing. Download full holdings, search for De-SPAC tickers, tag negative operating cash flow, and add up combined weights across your funds. If the total in Unprofitable, Launch, Constellation, and In-Space Service names tops 3% to 5%, you're carrying a pocket of long-duration risk that's invisible at a glance. This isn't about avoiding space or hating innovation. It's about sizing the bet you didn't know you made. In a zero-rate world, hidden long-duration exposure was a tailwind. In a higher-rate, tighter liquidity world, it's a lever that moves your portfolio more than you expect, right when you least want it. Next, I'll show you exactly where the exposure hides and how to check it in 5 minutes. Where the exposure hides. Don't stop at the top 10 holdings list. That's marketing. You need the full roster. Download the fund's complete holdings CSV from the sponsor's site. If it's an ETF, they usually post it daily or weekly. If it's a mutual fund, monthly or quarterly. Open it, sort by weight, then scan every line. The space risk rarely lives in the top 10. It hides in the 0.3% to 1.6% positions sprinkled across the middle. Here's what to flag fast. First, negative operating cash flow combined with recurring equity issuance. If the last 12 months show cash outflows from operations and the company ran an at-the-market program, did a discounted follow-on, or registered a big shelf, reduce the benefit of the doubt. Second, De-SPAC lineage. Search the ticker with Form S4 or De-SPAC to see if it came public via a merger. SPAC artifacts, warrants, earnouts, thin floats, raise volatility and capital risk. Now look for signals of stress. Guidance slips are the tell. If a company moved a revenue target out 1 or 2 quarters, that's manageable. 3 or more becomes a pattern. Read the latest 10Q and earnings call transcript. Phrases like rephasing milestones, supplier delays, launch window constraints, or insurance market conditions often precede raises. Add going concern language or auditor emphasis of matter paragraphs to your red flags. Those aren't doomed by themselves, but they tighten the financing window. Here's what most people miss with funds themselves. Methodology drift. A space ETF that couldn't find enough pure plays may have broadened to beneficiaries, which lets it tuck risky microcaps next to blue-chip industrials. Pull the index methodology or active mandate and compare early fact sheets to the latest ones. If definitions widen, expect more speculative names inside. Watch creations and redemptions. For ETFs, big net redemptions mean the fund is a forced seller of whatever it owns. Big creations mean forced buying. That's flow, not conviction. If an ETF holds your riskier space names and its bleeding assets, those names can get mechanically sold into weak bids. That's why you care about fund AUM trends, not just expense ratios. Overlap is the quiet concentration. Take your full holdings CSVs for every fund you own, stack them, and tally duplicates. You'll often find the same 4 or 5 De-SPAC launch or Constellation names repeated across space, innovation, and defense tech products. Each may be sub 1%, but together they add up. The real metric is combined portfolio weight per underlying name, not per fund. Set thresholds. If your aggregate exposure to Unprofitable, Launch, Constellation, and In-Space Services exceeds roughly 3% across all funds, highlight it. That's not a panic number, it's a know what you own number. Over 5%. Decide if you're truly underwriting the execution and financing risk, or if you'd rather own broader, cash-flowing exposure to aerospace via diversified industrials or defense primes. Drill one layer deeper on unit economics proxies. Launch companies. Check cadence, reuse targets, and insurance costs mentioned on calls. Constellations. Look for ARPU, churn, and capex intensity per satellite. In-space services. Seek clarity on recurring revenue versus milestone payments. Thin or missing disclosures aren't disqualifying, but they raise the bar for position size. 2 quick microchecks. 1. Warrant overhang. If a fund holds a name with millions of outstanding warrants near the money, upside is structurally capped until those clear. 2. Insider unlock calendars. If a lockup expires within the next quarter, expect supply. Funds rarely hedge that timing. You can. Finally, keep a small watch list of alerts. For each flagged name, set news triggers for ATM, convertible, PIPE, warrant exercise, guidance, and going concern. For each fund, set alerts for methodology change, reconstitution, and creation/redemption spikes. You're not trying to trade headlines. You're trying to avoid being the last one to notice mandate creep and dilution. The simple version is this: exposure hides in the long tail of holdings, in permissive fund mandates, and in the overlap across your own funds. Negative cash flow, De-SPAC history, guidance slippage, auditor flags, warrant overhangs, and lockup calendars are your red lights. Cap your aggregate weight, prefer vehicles with transparent, disciplined methodologies, and remember, when liquidity tightens, baskets sell together. Control the basket before the basket controls you. Your 5-minute portfolio exposure audit. Let's make this practical. 5 minutes. 1 coffee. No new software. Step 1. List every fund you own. Open your brokerage and retirement accounts. Copy tickers for all ETFs and mutual funds into a blank note. Include target date funds and core index funds. Those often hide the overlap. Step 2. Grab full holdings. For each fund, go to the sponsor's website and download the complete holdings CSV, not the top 10. ETFs usually provide daily updates. Mutual funds are monthly or quarterly. Save each file with the fund ticker in the name so you don't mix them up. Step 3. Quick filter. Open the first CSV. Use search for space-adjacent keywords. Space, launch, satellite, orbital, constellation, aerospace, and company names you recognize from headlines. Tag anything that's obviously a space pure play. Then tag De-SPACs by scanning for tickers you've seen tied to SPAC mergers. If unsure, search the ticker plus S4 or De-SPAC in a browser tab. Step 4. Flag negative cash flow. You don't need a model, just a snapshot. Open each tagged company's latest quarterly filing or investor deck and look for operating cash flow. If it's negative over the last 12 months and the company has raised equity recently, ATM program, PIPE, convert, or secondary, add a red dot in your note. Step 5. Compute combined weights. For each tagged name, note the weight in the current fund from the CSV. Then repeat across your other funds. Add those weights together by underlying company. You're building the number that matters, your aggregate exposure to each speculative name across all vehicles. Step 6. Rank your top 5 risks. Sort those combined weights from largest to smallest. You'll see 2 patterns, a couple of names repeated across multiple funds, and a tail of tiny positions. Circle the top 5 combined positions. These are your drawdown drivers if space sentiment sours or financing windows tighten. Step 7. Check structural headwinds. For each top name, do a 60-second scan. Outstanding warrants, near the money equals capped rallies, insider lockup dates, supply coming soon, and recent guidance language, any slips or rephasing talk. If 2 or more flags show up, mark the name fragile. Step 8. Assess fund behavior. Pull the fund's recent creations/redemptions trend from the sponsor or third-party sites. Net outflows mean the fund could be a forced seller. If a fund with several of your tagged names is bleeding assets, put a small flow risk note next to its ticker. Step 9. Set thresholds and decide. Use simple rules. If any single speculative name exceeds 1.5% combined weight, consider trimming via the fund with the loosest mandate. If aggregate exposure to unprofitable launch/constellation/in-space services is above 3% across your portfolio, decide whether that's a conscious bet or accidental overlap. If you want the theme, but less fragility, swap one theme fund for a broad, profitability-weighted or cash flow screened ETF that still includes aerospace exposure without the thin floats and warrants. Step 10. Act at the vehicle level. Don't try to stock pick your way out of this unless you live in the filings. Adjust the funds. Replace the product that introduced the overlap with one that fits your risk rules. Keep the play, lose the plumbing risk. 2 microchecks before you click trade. 1. Look at the new fund's full holdings to confirm it isn't sneaking in the same names. 2. Glance at expense ratios in AUM. Tiny, expensive funds can be flow volatile too. Set maintenance. Put a quarterly reminder on your calendar. Re-download full holdings, resum combined weights, rerun the top 5 list. Add simple alerts for each flagged name. ATM, convertible, warrant exercise, going concern, guidance, and for each fund, methodology change, index reconstitution, creation/redemption spikes. A quick example to anchor it. You hold 3 funds, a space ETF, an innovation ETF, and a defense tech ETF. Full holdings show the same 4 De-SPAC names at 1.2%, 0.9%, 0.8%, and 0.7% across funds. Combined, the top two names are 2.3% and 1.8%. Two have negative operating cash flow and recent equity raises. One has near-the-money warrants. One has a lockup expiring next month. You swap the Innovation ETF for a broad profitability-weighted index. New combined exposure drops to 2.1% total, warrants and lockup risk cut in half, and your portfolio's sensitivity to space financing cycles falls, without abandoning the theme. 5 minutes. 1 coffee. No heroics. Just control the basket before the basket controls you. Your future self will thank you on the next innovation sell-off. What a pop looks like: rates, liquidity, flows. Okay, so basically, a pop isn't a single headline. It's a sequence. Rates up, liquidity down, funding windows narrow, and flows flip from tailwind to headwind. Then the plumbing does the rest. If you're holding through ETFs, that sequence hits you whether or not you ever picked a single space stock. Start with rates. Higher discount rates compress long-duration assets mechanically. If your DCF moved cash flows from year 3 to year 5, and the rate jumped 2 points, valuation tightens twice, timing and math. Even quality names feel it, because portfolio managers sell what they can, not what they should. That's why you'll see profitable primes trade lower alongside unprofitable launchers on bad days. Forced de-risking bleeds across sleeves. Next, funding freezes don't announce themselves. They just go quiet. Venture rounds stretch from 60 days to 180. Debt that once priced at SOFR plus 350 now asks for covenants and convert features, or just says come back later. Secondaries that were 5% discounts become 15% with warrants attached. Pipes demand board seats and ratchets. Every notch tighter shortens runways, so management teams preemptively cut capex, slow hiring, and rephase milestones. Each action pushing revenue recognition further out, which circles back to the rates problem. Equity lifelines get pricier right when you most need them. A company that planned to raise $150 million at $10 now raises $90 million at $6 with 20% warrant coverage. That adds dilution and a cap on future rallies. Worse, the market learns to anticipate raises after any schedule slip. The bid steps away, spreads widen, and ATM programs drip supply into weak tapes. You feel it as a grind. Lower highs on good news, lower lows on bad news. Here's where ETF flows turn a correction into a pop. Inflows on the way up, forced buying. Outflows on the way down, forced selling. If space and innovation funds see net redemptions, they sell underlying names mechanically, regardless of fundamentals. Thin float tickers gap on small orders, so blocks print at air pockets. That accelerates drawdowns, which triggers more outflows, which forces more selling. It's a feedback loop with a clock, daily creations and redemptions. Correlation spikes are the tell that the pop phase has started. Names with different businesses start moving together because they share holders and baskets. Risk models go from idiosyncratic to factor. In crunches, the junk beta spills into quality beta. That's why even cash-flowing suppliers dip. They live next to long-duration names inside the same ETF, and the basket sells first, asks questions later. Timeline, in practice, looks like this. Phase 1, repricing. Multiples compress quietly over weeks as rates and misses compound. Headlines still sound optimistic, but the charts trend down. Phase 2, capitulation. A cluster of companies raise at steeper discounts, a high-profile milestone slips, or a covenant waiver leaks. Prices gap lower on volume. Social feeds go from diamond hands to silence. Phase 3, cleanup. Weak hands are out, financings reset balance sheets, and survivors guide conservatively. The index reconstitutes. ETFs drop the smallest, most illiquid names. Liquidity returns, but at new price anchors and with shareholders who demand cash flow before narrative. The counterintuitive part: good news during a pop can still be sold. A successful mission lifts price at the open, then bleeds as warrant exercises and ETF outflows meet it. The signal to watch isn't the headline. It's whether the tape can absorb supply without making lower lows. When it can, you're leaving capitulation and entering cleanup. When it can't, you're still repricing. So what should you watch right now? 3 dials. 1. Rate expectations. If front-end yields stabilize or drift down, the mechanical compression eases. 2. Primary market prints. Track the size, discount, and structure of raises. Tighter discounts and fewer warrants mean the window is reopening. 3. ETF AUM trends. Net creations in space and innovation funds flip the flow sign from seller to buyer. A quick microstory to make it stick. In the early 2000s, broadband names that eventually won still dropped 60% to 80% as capital costs rose and timelines slipped. Survivors tightened burn, hit milestones, and raised less dilutive money. Their stocks based for quarters, then climbed on proof, not promise. The losers kept promising next quarter, raised into weakness and washed out. Same mechanics, new sector, faster tape. What this actually means is you don't need to predict the day the pop peaks. You need to position for the sequence. Shorten duration in your fund choices, cap speculative exposure, and wait for those 3 dials to turn. When the flow, funding, and rate dials align, even modestly, survivors will have a platform to rebuild valuation on execution, not air. That's when you scale in on proof, not promise. Lessons from 1999 that apply now. Here's what most people miss about 1999. The internet didn't fail, the pricing did. The lesson is simple but hard to live by. Business models survive, bubble math doesn't. Translate that to space. The physics and demand may be real, but if your valuation assumes free capital and flawless execution, you're rerunning the dot-com script. Start with myth versus business. In 1999, eyeballs were used as currency. Traffic validated interest, not profit. In space, successful demo, anchor contract, and first orbit can play the same role. Validation is necessary. It isn't sufficient. What mattered for the dot-com survivors was converting validation into repeatable, high-margin revenue. Today, the space survivors will be the ones that turn milestones into renewals and unit economics that work without subsidies. Cash flow primacy is the rule that ended the dot-com party and crowned its winners. Amazon didn't survive because it had the biggest story. It survived because it relentlessly drove down costs, expanded gross margin pools, and eventually produced durable cash flow. The analog for space is cadence and reliability, translating to lower cost per kilogram and stickier service contracts that deliver gross margin at steady cadence. Until operating cash flow turns, price is a belief. When it turns, price becomes optionality. Market share mirages fooled investors then and now. If we get 1% of global retail was a punchline in 2001. If we get 1% of $1 trillion space TAM is the same punchline today. In both cases, the real question is, at what margin? Revenue without margin is just a transfer of capital from shareholders to customers. For launch, that means discounting to fill manifests destroys the very scale you need. For constellations, that means ARPU must exceed lifetime CAPEX and OPEX, with churn low enough to compound. Anything else is a treadmill. Survivorship bias distorts memory. We remember the winners, Google, Amazon, so we forget the thousands that disappeared. That bias tempts investors to say, sure, most will die, but I only need one. True, if you can fund the losses and hold through 70% drawdowns without adding above your pain point. Most can't. A portfolio-level approach with strict sizing beats lottery tickets masquerading as investments. So what actually worked after 1999? 3 things. 1. Ruthless burn control. The winners cut costs fast, killed pet projects, and preserved optionality when capital disappeared. 2. Focus on unit economics. They priced for margin early, even if it meant slower growth, and used scale to widen moats. 3. Audited execution. Clean reporting, conservative guidance, and delivered milestones rebuilt trust long before headlines turned friendly. Apply that to space now. Winners will show cadence stability over press releases. A boring, steady launch rhythm with improving turnaround beats, weekly next year. Customer diversity and renewals. A mix of government and commercial, multi-year, with clear expansion paths and low churn. Disciplined capital. Raises done before desperation, with minimal warrants and CAPEX framed by signed demand, not hopes. A quick microstory from 2001 that maps cleanly. A web infrastructure company stopped chasing land grabs, tightened spend, and focused on high-margin managed hosting. Growth slowed, but gross margins rose, churn fell, cash burn flipped, and the stock based for a year before 10x, ING over 4. Translation for space. Cut non-core missions, price for margin, prove reuse or refurbishment cycles with data, and let valuation rebuild after cash turns. Here's the counterintuitive part. You don't need to call the bottom, you need criteria. In 2002, buying cheap didn't work unless businesses hit cash milestones. Today, a De-SPAC at $2 isn't cheap if it needs 3 dilutive raises to get to break even. Cheap is a function of future dilution, not just today's price. Practical filters you can apply now. Does guidance tie to audited milestones, not vibes? Are CAPEX plans funded for 12 to 18 months without heroic assumptions? Is there evidence of pricing power, not just backlog headlines? Do disclosures quantify failure rates, insurance, and reuse performance? If the answers lean yes, you may have a survivor. If not, you have a story tethered to capital markets. The dot-com lesson that matters most. Favor businesses that can fund themselves and compound, not narratives that require perfect weather. Risk-first framework. Position without prediction. Here's the mindset shift. Stop trying to guess headlines, start controlling exposure. You can't time milestones, funding windows, or rate moves with precision. You can choose what pocket of risk sits in your account, how big it is, and how it reacts when the plumbing gets noisy. That's positioning without prediction. Principle 1. Size the risk, don't moralize it. Speculative space exposure isn't evil, it's a lever. Cap it. A simple rule. Limit long duration. Negative cash flow names, directly or via funds, to a maximum slice you can emotionally and financially tolerate through a 60 to 80% drawdown. For many, that's 2 to 5% of total portfolio, not 10 to 15%. When in doubt, round down. Principle 2. Diversify across cash-flowing sectors to shorten duration. Pair any space sleeve with businesses that spin cash today. Consumer staples with pricing power, profitable software, healthcare services, utilities, and defense primes with multi-year funded backlogs. The goal isn't to kill upside. It's to dampen the portfolio's sensitivity to rates and funding squeezes that hit long-duration assets the hardest. Vehicle choice matters more than stock picks. Prefer funds with transparent mandates and discipline over broad, vibes-based innovation wrappers. If you want aerospace exposure without SPAC artifacts, tilt toward profitability-weighted or cash flow-screened indexes that still include primes, suppliers, avionics, and satellite operators with positive operating cash flow. Avoid theme creep. If a space fund quietly owns thin-float De-SPACs next to megacaps, assume mandate looseness elsewhere too. Rebalancing is your shock absorber. Set rules that trim when weights creep, quarterly or semi-annual works. For example, if your speculative bucket exceeds its cap by 25% due to a rally, auto-trim back to target and redeploy into your cash flow sleeve. If it falls 50% and you still believe in the thesis at the vehicle level, rebalance back only to your predetermined cap, not above it. Rules beat feelings. Liquidity is optionality. Keep a short duration, high-quality fixed income sleeve, treasury bills, short-term government funds, or investment-grade ultra-short. This isn't market timing. It's dry powder. When funding windows reopen and ETF flows flip positive, you'll have cash to add on better terms without selling distressed assets. Meanwhile, you earn something on the sidelines instead of zero. Monitoring should be light but specific. You don't need to become a rocket engineer. You need a few reliable tripwires. Set calendar alerts for company milestones that move cash in or out, capital raises, ATM, PIPE, converts. Warrant overhang clearance, insider unlock dates, and any guidance slips. At the fund level, watch methodology updates, reconstitution dates, and creation/redemption spikes. You're scanning for mandate drift and flow risk, not grading hardware. Positioning tactics you can implement tomorrow. Use a speculative sleeve and label it. Put all long-duration bets, space, pre-profit biotech, moonshot AI, inside that sleeve. Cap it. If you're at the cap, any new idea must replace an existing one. Prefer survivors' traits. If you want a direct space allocation, bias toward names with growing gross margins, improving cadence, diversified customers, and funded CAPEX for 12 to 18 months. If you can't confirm those, default to broader aerospace exposure. Map overlap before you buy. Add the new fund's full holdings into your existing CSV stack and scan for duplicates. If the same long-duration names already show up in 2 funds, consider passing or swapping. Here's the counterintuitive part. Doing less is often the edge. You don't need to trade every slip or pop. You need to avoid cumulative errors, averaging down without a thesis change, adding above your sizing rules after a rally, or sticking with a fund that drifted into risk you didn't sign up for. Your framework is a circuit breaker for enthusiasm. A quick micro-application. Say your audit shows 4.6% combined exposure to Unprofitable Launch and Constellation De-SPACs across 3 funds. Your cap is 3%. You replace the loosest innovation ETF with a profitability-weighted index that still holds defense primes and satellite operators with positive cash flow. New combined exposure drops to 2.2%. You set alerts on the remaining names for ATM, warrant exercise, and lockup. You park the proceeds not reinvested into an ultra-short treasury fund. If flows and funding improve, and the survivors demonstrate cash turn milestones, you can redeploy from a position of strength. What this actually means is you're building a glide path through the bubble's unwind. Control size, choose better vehicles, rebalance by rule, hold optionality, and monitor the few levers that move prices the most. You don't need perfect forecasts when your structure forgives imperfect timing. Case walkthrough, scan to action. Let's run a clean walkthrough so you can see this move from scan to action. Starting point, a $100,000 portfolio split across 3 growth-oriented funds. Call them a space ETF, a broad innovation ETF, and a defense tech ETF. No single space stock is owned directly. You think you're diversified. The audit will tell you if that's true. Step 1, we list the 3 fund tickers and grab their full holdings CSVs. We search for space-adjacent terms and tag De-SPAC line items. Quickly, 4 names show up across all 3 funds. 2 small launch companies, 1 constellation operator still pre-profit, and an in-space services firm with milestone revenue. Each fund holds them in small weights, 0.7% to 1.6%. But combined across funds, the top 2 names land at 2.1% and 1.5%. with the others at 0.9% and 0.7%. That's 5.2% exposure to long-duration names without realizing it. Next, we flag negative operating cash flow. The 2 launch names show LTM negative operating cash flow and recent equity raises with warrant coverage. The Constellation operator filed an ATM facility and guided CAPEX higher due to delays. The in-space services firm rephased milestones last quarter. 3 red dots, 1 yellow. Now we check structural headwinds. Warrant overhang? Yes, millions of instruments near the money on one launch name, slightly out of the money on the other. Lockup calendars? 1 unlock scheduled in 6 weeks for the services firm's early investors. Fund flow. The innovation ETF has seen persistent redemptions for 2 months. The space ETF is flat. The defense tech ETF has small net creations. Flow risk centered in 1 vehicle. So what do? We don't stock pick. We solve at the vehicle level. The innovation ETF is the loosest mandate with the highest overlap and the worst flows. We replace it with a profitability-weighted large/mid-cap ETF that still captures aerospace suppliers and primes, plus a focused industrials sleeve with positive free cash flow. We also keep the dedicated space ETF on purpose because we want controlled exposure to the theme, not zero. The defense tech ETF stays. It's heavier in primes and avionics with cash. Before we trade, 2 microchecks. 1. Confirm the replacement fund's full holdings don't quietly include the same De-SPACs. They don't, no overlap. 2. Sanity check the AUM and spreads. Both are liquid, with tight spreads and broad ownership. Post-trade, we resum combined weights. The 4 speculative names drop from 5.2% to 2.1%. The 2 launch names fall to 1.2% combined. The warrant overhang exposure halves. Lockup risk now touches 0.4% instead of 1.1%. We didn't abandon the space theme, we right-sized it. We allocate any remaining proceeds to an ultra-short treasury fund. That gives us optionality if flows and funding improve, or if the space ETF rebalances into stronger survivors after reconstitution. Meanwhile, we set 5 alerts: warrant exercise, ATM, convertible, guidance, and methodology change for the space ETF. We also calendar a quarterly holdings refresh. Here's the behavioral part. We write down our speculative sleeve cap at 3% for this account. If the space ETF rallies and our combined exposure creeps above 3.75%, 25% above cap, we trim back automatically into the profitability-weighted fund. If the sleeve falls 50% and we still believe in the theme via the vehicle, we rebalance back to 3%, not above. Rules over vibes. 6 weeks later, the services firm's lockup expires. The stock wobbles, our space ETF dips. But the impact on the overall account is a rounding error because we cut overlap ahead of the event. 3 months later, funding windows thaw a bit. The Constellation name raises with a smaller discount and no warrants. The ETF stabilizes. We reassess, not react. What this actually shows is simple. The audit surfaces hidden concentration, the swap cuts fragility, and a small liquidity sleeve keeps you playing offense without guessing headlines. You didn't need a new thesis. You needed plumbing awareness and a position size that respects the calendar and the capital. Traps to avoid during the unwind. Now, the part that saves the gains you just protected. Avoiding the traps that show up during an unwind. First, chasing bounces. Bear market rallies feel convincing because thin floats and headline beats can push prices up 30% in a day. But remember the structure. Warrant exercises fade strength, ETF outflows sell into pops, and insiders may be unlocking. If you trimmed based on rules, don't add back just because the tape looks better for 36 hours. Require a funding print without sweeteners or a cadence milestone tied to revenue, not demos. Second, narrative anchoring. We have a government contract. Sounds like a margin shield. It isn't. Milestone payments smooth burn. They don't guarantee profitability or reuse rates. If guidance slips while contracts remain, trust the math, not the headline. Anchoring to the original deck, year 5. Margins and weekly next year. Keeps investors averaging down into dilution. Update your view with today's runway, not yesterday's promise. Third, averaging down without a thesis change. If your speculative sleeve cap is 3%, you don't get to 5% just because a name is cheaper. Down 70% is not a thesis, it's a price. Averaging down only works if dilution risk recedes, cadence stabilizes, and the path to operating cash flow gets clearer. If those aren't present, you're adding duration risk when capital is tight. Respect your sizing rules. Fourth, diversified complacency. Owning 5 funds isn't diversified if they share the same long duration factor. Overlap blindness is the silent killer. Rerun your combined weights quarterly. If the same De-SPACs show up across multiple wrappers, fix the vehicle, not the narrative. Themed products are built to hold themes, not to manage your cross-fund concentration. Fifth, confusing validation with valuation. A successful mission is validation. A sustainable cadence with improving unit economics is valuation. The unwind tempts you to declare victory on validation and ignore financing friction. If each success still requires another raise, you're renting the rally. Wait for the tell. Tighter secondary discounts, fewer warrants, and cash from operations trending less negative. Sixth, overreacting to single prints. One awful quarter in a cleanup phase doesn't doom a survivor, just like one great quarter in repricing doesn't redeem a struggler. Use your 3 dials, rates, funding prints, ETF flows, to frame whether you're in repricing, capitulation, or cleanup. Your playbook changes with the phase. In repricing, you cut overlap. In capitulation, you protect and wait. In cleanup, you can add measured exposure to vehicles with cleaner holders and funded plans. 7th, ignoring liquidity risk in your replacements. Swapping out of a loose innovation fund into a niche alternative with tiny AUM and wide spreads trades one plumbing risk for another. Liquidity is part of risk management. Pick replacements with scale, tight tracking, and mandates that won't drift when marketing needs change. 8th, letting tax tail wag the dog. Wash sales and gains matter, but not more than concentration and drawdown risk. If trimming overlap triggers taxes, consider offsetting with harvested losses elsewhere or stagger exits across tax periods. Don't keep a fragile sleeve just to avoid a bill if the potential drawdown dwarfs the tax. 9th, falling for value because it's $2. Low price per share doesn't mean low valuation or low dilution ahead. Calculate enterprise value after convertibles, warrants, and ATM capacity. If the path to break-even needs 2 more raises, today's cheap can become tomorrow's permanent capital loss. Finally, analysis paralysis. The audit is intentionally simple. Don't wait for a perfect model to cut obvious overlap and fund mandate drift. Do the 10 steps, enforce the cap, set alerts, and move. The advantage isn't predicting which rocket flies first. It's preventing hidden plumbing from dictating your outcomes. Here's the quiet win. By avoiding these traps, you keep dry powder, emotional bandwidth, and structural flexibility. When survivors prove cash turns, you'll be able to add without fighting warrants, lockups, and forced ETF selling. That's how you compound through an unwind, slow, boring, and with rules that protect you from your best stories at their worst moments. The takeaway is simple. Innovation isn't the risk. Paying today for profits 5 to 10 years out, with warrants, lockups, and thin floats, is. Run the 5-minute audit tonight. Pull full holdings, tag De-SPACs and negative cash flow, add combined weights, cap your sleeve, and set alerts. Subscribe for the checklist and templates. Then watch the follow-up on hidden overlap inside popular innovation funds and how to swap into profitability-weighted exposure without losing the theme. Do this now, before the plumbing decides your returns. Appendix, quick reference checklist. Red flags to spot fast, negative operating cash flow, and recurring equity issuance. If LTM operating cash flow is negative and the company's filed an ATM, run a discounted follow-on, or issued converts with warrants, raise caution. Guidance slippage. 3 or more timeline pushes turns drift into pattern. Terms to note: rephasing, cadence adjustments, supplier delays, launch window constraints. Dilution signals. Shelf registrations, pipe chatter, convert discussions, or capital structure optimization language. Going concern notes or auditor emphasis of matter paragraphs. These don't mean failure, but they tighten the financing window and embolden counterparties. Cash runway under 18 months at current burn, absent committed financing. SPAC artifacts that amplify volatility. High redemptions leading to thin floats. Expect exaggerated moves on small orders and headlines. Warrant overhang near the money. Upside gets sold. Into rallies fade. Insider lockup calendars. Supply hits post-expiration, often before operations catch up. Earnouts and contingent shares. Future dilution tied to price levels can pressure breakouts. Public by press release behavior. Stock reacts more to announcements than audited progress. Unit economics quick checks. Launch. Cadence realized versus promised, reuse cycle counts, insurance costs, and manifested backlog quality. A slower, reliable ramp beats weekly next year. Constellations. ARPU versus lifetime CAPEX/OPEX per user, churn trends, ground segment cost scaling, spectrum/licensing risks. In-space services. Milestone versus recurring revenue mix, margin on recurring, customer renewals, and service intervals tied to actual on-orbit data. Fund hygiene essentials, mandate drift. Compare current methodology or prospectus language to earlier fact sheets. Beneficiaries language can sneak microcaps beside blue chips. Concentration versus disclosure. Don't trust top 10 lists. Download the full CSV and sort by weight. Creation/redemption trends. Persistent outflows force selling. Creations force buying regardless of fundamentals. Reconstitution dates. Index reshuffles can eject illiquid names at bad prints or add fragile ones into strength. Overlap and concentration. Stack all fund holdings and tally duplicates. Combined position size in the same underlying name matters more than weight per fund. Watch cross-theme duplication. Space, innovation, defense tech. And even some growth wrappers often share the same De-SPACs. Thresholds. Highlight when aggregate exposure to unprofitable launch/constellation/in-space services exceeds 3%. Over 5% demands an intentional choice. Risk rules you can adopt. Speculative sleeve cap at 2 to 5% of the portfolio, sized for an 80% drawdown without panic. If you're unsure, start at 2 to 3%. Rebalance rules. Trim back to target if the sleeve rises 25% over cap. If it falls 50% and your thesis is vehicle-level sound, rebalance back only to cap. Vehicle selection. Prefer profitability-weighted or cash flow-screened funds for core exposure. Keep theme funds as labeled satellites with strict size limits. Liquidity buffer. Park 5 to 15% in short duration, high-quality fixed income for optionality when funding windows reopen. Monitoring cadence. Quarterly. Re-download all fund holdings, resum combined weights, refresh top 5 risk drivers, review fund creations/redemptions, and scan for methodology updates. Event-driven. Set alerts for ATM, convertible, pipe, warrant exercise, guidance, going concern, lockup expiration, and index reconstitution. Rates and flows. Watch front-end yields, discount structure on secondaries, and ETF AUM trends in space/innovation sleeves for phase shifts. 5-minute audit recap. List all ETFs/mutual funds across accounts, including target date funds. Download full holdings CSVs from each sponsor. Filter for space-adjacent terms and tag De-SPACs. Flag negative operating cash flow plus recent dilution. Add combined weights per underlying name across funds. Rank top 5 combined exposures. Mark those with warrants, lockups, or guidance slips as fragile. Decide actions at the vehicle level. Swap loose mandates for profitability-weighted or broad core exposure. Cap the sleeve. Set calendar and news alerts. Repeat quarterly. Final sanity checks before trading. Confirm replacements don't hold the same fragile names. Verify AUM, spreads, and tracking. Avoid tiny, flow-volatile products. Mind taxes, but don't let them override concentration risk. Stagger exits if needed. Use this as your filter until the market reprices reality. Control size, clean mandates, short duration, and light monitoring beat prediction when bubbles deflate.